The panel comprises of Kaj Burchardi, Markus Franke, David Johnston, and it's led by David Namdar. David is a GP at Coral Capital and the co-founder of NFT.com. He's extremely experienced in the industry, co-founding partner of Galaxy Digital and SolidX, invested in 100 companies, but we love him in particular because he's a volunteer on the advisory board of CfC. So some of the amazing speakers and content have definitely come from David. Please welcome the panel to the stage.
Good morning, everyone. Thank you, Eric, and thank you, everyone, as part of the CfC staff, because we're all so privileged and excited to be here. I've been coming for a number of years. I pointed out my friend George over there because I was telling him at the beginning of the last panel that he could be on the investor panel. And one of the things I like to do is encourage everybody here that and this comes up in a lot of conversations, that you're not too late. There's so many opportunities ahead, and I hope everybody gets inspired by being here at the conference, learns, starts investing in the space, and starts companies in the space. So now we've got an awesome panel, I think, which is one of the most important topics in understanding kind of how crypto and how the whole market has gotten to where it is today, and that's the concept of stablecoins. And so, one of the most important things to realize is at the very beginning in the crypto market, it really was the Wild West, and there was so much friction. And it wasn't until the invention of Tether and the invention of the idea of stablecoins that the market was able to kind of really start to grow and take off. So with that, why don't you guys just do a quick introduction, and then we'll dive into things.
Sure. David Johnston from DLTx. Spoke yesterday, so most people probably know me, but we're a publicly traded company in Norway, and basically build Web3 infrastructure. So been in the space since 2012, and it's a pleasure to be here today.
Cool. Hi, everybody. My name is Markus Franke. I'm working on Celo. Celo is a mobile-first layer 1 platform enabling all sorts of DeFi applications for mobile phones. Why mobile? Because many people today don't have access to a bank, but a lot of people have access to a mobile phone. Therefore, we see a lot of adoption also for stablecoins on mobile. Celo has also a stability platform on it, the Celo stablecoins. There's a Celo dollar, Celo euro, Celo Brazilian real, and I'm focused on this stability platform. Amazing.
And my name is Kaj Burchardi, Managing Director with BCG, so Boston Consulting Group, global lead for blockchain, and we help enterprises, but also crypto companies to define their business model, their business strategy, and then implementing the entire technology stack to make it happen.
Great, thanks, guys. So between each of them, myself, 2012, with David Johnston was one of my earliest friends in the space. So we've been doing this for a long time. Marcus told me just now he's been involved since 2017, and Kai since 2015. And we actually interacted back then with my first company, SolidX. So Marcus, why don't you kick us off? Kind of give us a little bit of an overview of the whole stablecoin space and how it exists today.
Sure, happy to always talk about stablecoins. They excite me a lot. And when you think about stablecoins, you can differentiate them, for example, by their stability mechanism itself. You've mentioned Tether and USDC, I think, first, and these are, I would guess, from a stability mechanism, probably on a glimpse, the easiest to understand, because the stability mechanism is that they hold or should hold fiat as a collateral. They are fiat-backed, and that therefore they try to be stable. They are also crypto-backed stablecoins. The advantage there is that they are more transparent, that they could be more decentralized, and therefore there's not a centralized risk to the stability mechanism. DAI, for example, on Ethereum is an example. And there are also seigniorage type of stablecoins. Terra is an example that has a seigniorage token that takes up the volatility of the stablecoin and therefore keeps the stablecoin safe. And for the Celo stablecoins, I would say it's an algorithmic type of stability mechanism. Algorithmic means it's a smart contract-based mechanism that adjusts the supply of stablecoin to different levels of demand so that the price is kept stable. I think that is like a broad overview on what are the different mechanisms. Each mechanism has different risks to it. I think one common risk for all these stablecoins is the demand shocks. To have a stable stablecoin, you need demand for it, so people should be able to use it. So the easier it is to use it, and the more integrations there are, the better for the stablecoin.
Yep, and we'll jump more into those risks in a minute. But yeah, I think it's important to understand, right? We had things like Tether that was born out of a need. When people sold Bitcoin on some of the earliest exchanges, the problem was that the banking system and the regulations around it really limited the flow of funds into and out of those exchanges. And so Tether sped that up. And so a lot of the earliest trading and market making firms used Tether to immediately send between different exchanges, and they were able to do the arbitrage and provide liquidity and improve the liquidity of the whole space. And then USDC emerged from a need to have a more regulated stablecoin, and all the algorithmic ones emerged from a need that really people within the crypto space identified, that maybe it's not so good to have it backed by a fiat currency sitting in a bank account. So now, Kai, that's something you've been focused on a bit more, and also how the central banks have been viewing and kind of approaching the space. So do you want to touch on that?
Yeah, so maybe one additional dimensions. You have the open stablecoins, USDT, USDC, and so on. You also have a little bit the proprietary stablecoins like JP Morgan coin, which is much more completely different business model, but interesting in order to help enterprises with multi-jurisdiction setups to create a different way how to fund their necessary elements and balance sheets in the different jurisdictions. Now, what we currently see is the specific question of is there a way for stablecoins the moment CBDCs come on top? And especially when we differentiate CBDCs in terms of wholesale, so only within the financial sector, or also CBDCs for non-financial institutions, meaning a retail client as us, or enterprises. The moment you have that one, it's a question. When are you using stablecoins, and when could you or should you actually use CBDCs? And the central banks and regulators currently are in a pretty tricky spot, let's put it that way. Because the moment you give CBDC, so legal tender currency, to a retail client, it will move away deposits from the normal banks. And therefore, it has an impact on the economy because they cannot give loans anymore. Now, on the other side, they don't like stablecoins necessarily because they're not that regulated, right? And therefore, it's exactly this trade-off that the regulator and central banks are currently in, trying to find a way up to the point where it's a consistent or parallel play that stablecoins still exist, but CBDCs in one way or the other design will emerge. And maybe over time, then the central banks and the commercial banks have to deal with a platform play of DeFi and so on, where more and more CBDCs can play a role instead of stablecoins. But what we currently see, it's a easily five-year plus horizon, and it needs to emerge first.
Yeah, of course. And I think an important point that Kai highlights is that every company, after JP Morgan and Citi and a couple other of the big banks announced their own kind of approach to a stablecoin, every company and every country is now looking and thinking about their play and their approach to this. And they're going to guys like Kai and other experts in the space to kind of help them figure this out. So David, you've been writing about this a long time. So I'm going to ask you first just to kind of give kind of some of your own insights into how the market's evolved and kind of what some of your biggest concerns have been, and the things that excite you the most about it.
Well, it was interesting how it evolved, right? The only platform you could build on at first was Bitcoin, right? So we saw the Mastercoin, which eventually became OmniLayer, is where Tether was initially developed and launched. And it did pretty well. It grew to about $1 billion in stablecoins. But once they ported to Ethereum, it really took off as far as volumes and obviously faster transaction speeds. And so that's sort of when they really went mainstream. And as you pointed out, it really started as a means of trading between the cryptocurrencies and keeping your value on chain. So you could immediately go back into the assets you wanted. Nobody wanted to go back to the financial system because you'd suffer a delay of a week or two to get the wire and the money to clear and all the rest. So that's where it started, and really Tether dominated early on, but we've seen USDC come in almost with a different use case, right? There's a lot less daily turnover, and it seems to be much more used for payment mechanism, right? Investors sending money into a deal, they're willing to hold it longer, maybe they have more faith in its transparency. So we've sort of seen that evolution happen, and now we're seeing the addition of all these algorithmic coins, which I think is great, because it gets us away from the risk of a central point of failure with an entity that has to be trusted to keep the collateral. And if it's not on chain, how do you know the collateral is there, right? And so I've written a number of articles. I was actually pretty concerned about Tether and some of the stable coins a few years ago. I think some of those risks have now been mitigated as the industry has become more diversified, right? 2 years ago, Tether was, what, 80, 90% of all stablecoins in existence. And today it's getting closer to 50%, something like that. And so we have all these new entrants really bringing diversity. So there's not one project that if that went offline, then all the projects would be effective. There's lots of places you could move the capital to. So I'm very encouraged by that development.
Yeah, and I am as well. And so I've actually spent probably, maybe more than almost anybody in the world, spent more time defending Tether and trying more just, not because I have any vested stake there. I mean, I know the team, but it's more because what I just spend time doing is really when I see things that people are worried about that keep them from kind of having an open-minded approach to the space, I try to just help plant the seed and get them past that resistance. And so with Tether, I've told people over and over throughout every cycle that, look, it's an incredible business model, that they're incentivized to keep it going, right? And they're making a ton on the net interest margin on the spread. And so, even though there are concerns in every cycle and every year about what's backing their reserves, and there very well may be a problem in the future, it's something, if you were concerned about that and that kept you out of the crypto market, it's actually hurt you more than it's helped. And so I guess with that, so what are, Markus, yesterday we were talking a little bit about what's happened with DAI and how it almost died in the last cycle. So do you want to kind of explain that and explain some of the risks that happen with the algorithmic stablecoins?
Yeah, happy to. And it's really cool that what we see in this technology, and also what you said, and also what you said about CBDCs, is that this technology actually allows for competition among currency. We haven't seen a lot of innovation on money as a technology itself over the last 400 years. We have seen innovation in how you pay, but not on money itself. And actually this technology now enables innovation on money directly. And therefore it creates also competition between these different types of stable coins, between central bank digital currencies and more decentralized currencies, between maybe local and global currencies, and also between traditional currencies and maybe in future cool things like nature-backed currencies and stuff like that. And on the risks, and what we've seen, for example, in DAI, is one fundamental thing in economics is that you should try to make demand and supply meet at a certain price. And in the case of a stablecoin, supply and demand of stablecoins should meet at a price of, for example, in a case of a dollar-based or dollar-tracking stablecoin, at the price of $1. And what we've seen with DAI when it depegged some time ago was actually when the price of ETH fell, and a lot of CDPs that are used to create DAI into existence were called, and the supply of DAI basically was contracted, that the demand still stayed the same. And therefore, although the crypto market was in a downwards trend, DAI actually depegged to a positive price. And we've seen these depegs in different kinds of stability mechanism. We also seen these depegs in fiat-backed stablecoins as well. We've also had periods where Tether depegged. And I think the common ground is what I mentioned before. You need to have basically a mechanism that matches supply and demand, so that if there is a demand shock to the stablecoin, the price actually still stays stable. And this is a part, basically, also why there is competition among stablecoins, because they have different stability mechanisms there.
Well, in some ways, I think that's one of the most important features of what's happening with all the different stablecoins, both fiat-backed and algorithmically backed, in that they're inviting and creating competition, right? And so, as when you think about all this stuff, and we don't often think of money as something related to innovation and as an experiment, but now we're within the crypto world, redefining what it means to have a currency and what it needs to be backed by, and what value people put on it. And so I think that's a really important point, that there is going to be competition, and hopefully competition leads towards better and better currencies. So now, Kaj, from your experience with both corporates and governments, how do you think they're viewing some of the algorithmic stablecoins?
Well, maybe one point on competition, and then also on algorithmic. I think for algorithmic first, it's probably even more difficult for them to understand, and because they understand, hey, I have a collateral, it's in one way or the other secured, it's audited, I can live with that, right? On algorithmic, they would need to really understand the code and the mechanism of it. And we see already there's an education gap on regulator side, on central bank side. So you have to close even a bigger gap to get this done, right? So I'm a bit careful projecting how they feel about algorithmic part in a regulated environment on the one hand side. Now on the competition side, I think we have a few characteristics which might be really interesting in the near future. One is, and you mentioned it, the decentralized risk of the collateral, right? I think there are some first ideas how to decentralize the collateral and remove the counterparty risk the moment the holder of the collateral goes bankrupt. We probably see during this year quite a bit of conceptual innovation in that. The second one is with regard to programmability, so that you really use the technology capabilities of a stablecoin as well to enable programmability on top of it, which is really a really innovation add-on compared to any kind of mobile money in that sense, right? And last but not least, the way how the regulator can also understand the KYC and AML questions, which for them is the fundamental part of, well, if I don't understand and control that one, I have a problem with that, right? And that's what you see with all the regulatory ideas or thoughts in the US, but also in Europe and so on. They have to deal with this because it's going into the fiat currency world, and then you have to stop this, but then it can overshoot. We heard it yesterday in the travel rule. You can only transfer $10K US with a stablecoin. That doesn't make sense, right? So we have to solve this differently.
Right, absolutely. And so that kind of ties into, I mean, in the last cycle, one of the ways I explained what was happening during this whole ICO boom was that Bitcoin and Ethereum became the funding currencies for the whole digital asset ecosystem. Yep. So people had to buy or get Bitcoin and Ethereum first in order to invest in all the other innovation that was happening. Now, David, as you mentioned, stablecoins are being used for investment, and companies are more willing to receive it. So,
I would say effectively you have, let's call them, reserve currencies in crypto, and there are probably 4 at this point that are liquid enough to really serve that function. So first was Bitcoin, the Ethereum, token sale. You had to have Bitcoin. You literally couldn't participate with anything else, right? And so, we went from that to now ETH. Okay, there's a lot of liquidity in ETH. Lots of people do things based on that. But now you add Tether, and you're increasingly seeing USDC. So those are usually the 4 that I see. If somebody's doing some sort of funding, they're willing to accept those 4 currencies. Though, as it becomes sort of more connected and interoperable, like you're saying, I expect that list will continue to grow. And the challenge is the liquidity, right? And can we, sort of bring together the liquidity pools, right? And a lot of that has to do with the Ethereum virtual machine. You see most of the successful chains that have come out of the last few years, whether it's Solana or Polygon or others, they're all using Avalanche, they're all using the EVM, right? And that gives me interoperability of smart contracts, right? I don't have to rewrite all of my code as a developer, which developers don't want to rewrite all their code for every new chain that they join. But that's not the same as liquidity, right? And so, okay, my program will run and I can run it faster and maybe cheaper, but the first thing people do is build a bridge back to Ethereum because that's where all the liquidity still is. And so can we get interoperability of liquidity? That's a very hard technical challenge, right? We've seen a lot of projects trying to crack that nut, whether it's something like Thorchain, where they're trying to create a way for people to exchange native assets, native Bitcoin, native Ethereum across chains. Those are still early, but that's what I think will sort of unlock sort of this next evolution, is if you can have interoperability of liquidity and not just code.
Right, absolutely. And I think we're definitely seeing the kind of seed stages of that, but this is one of those things from one cycle to the next, right? Where we put out the ideas now, and then by the next cycle, we'll actually achieve that. So even now, I'm thinking back, go back 3-4 years, and I think maybe 5-10% of the activity I was doing in the crypto space was in using stablecoins.
Yeah.
Now today, right? If I think of in my fund, we take subscriptions in USDC and in fiat.
Sure.
More, I don't know the exact numbers, but the majority of them are coming in USDC, and by far the majority of new investments we make, maybe as high as 80-90%, are in USDC and not in fiat. So along those lines, what would you guys say your percentages are of kind of how active you're using stablecoins today, and then what are some of the things I could think other than the portability that you think are important to pay attention to going forward?
Yeah, I'd say a similar ratio, maybe 80% USDC for funding projects and stuff like that. In the case of DLTx, at least with, let's say, Bitcoin mining, I would like to have my source of capital be the same thing that I'm creating, right? And so that's how I avoid the currency trap of getting caught on one side or the other of appreciation or depreciation of the assets. And we do the same with Filecoin, right? We borrow Filecoin, we mine Filecoin, we return Filecoin denominated in Filecoin. So I think there's sort of important exceptions when you can sort of get that straight line of de-risking a particular asset. But for the most part, yeah, if it's investment related, it's USDC.
And actually, eventually, just to plant the seed, I think you might be distributing dividends in stablecoin.
I have no public announcements to make this one.
How about the two of you?
Dividends or rewards, depends on how we should call it. But I actually like this story, basically, that also interoperability is driving liquidity.
Yep.
I think also, therefore, I mean, for us, it was important when we launched Celo to also be EVM compatible, to have the smart contracts on Celo written also in Solidity, right. That it's easier, as you said, for the developers to write basically in the same language. I would add that also ease of use of the stablecoin in future will drive liquidity, because, as you said, today, a lot of the stablecoins are used in trading, and trading is done by crypto experts that have been in the space for quite some time. So they are used to the concept of gas fees. They are used to the concept that for some stablecoins you have to pay high gas fees in a different currency that is not stable anymore. If you think about end user for peer-to-peer payments, there the user is not used to these concepts, and therefore for the Celo stablecoins, one feature is that if I send a transaction in Celo dollar or in Celo euro, I can also pay for gas in Celo dollar and Celo euro, right. And I can send it to a phone number basically, and that makes it very easy to use. For other use cases than just for trading, I can use it for remittances. I can use it for all the DeFi applications transferred to real life, saving, lending, and borrowing to actually maybe finance a venture that is not based on blockchain, stuff like that. So I think usability is also extremely important going forward.
Now, is Celo paying any salaries in stablecoin yet?
Yes. So I get all my salary either in the Celo native asset or in Celo euro, since I'm based in Europe.
Oh, wonderful.
That's cool.
So I think I would differentiate really by use case. So the moment you go much more for retail, which might then be more in the close to regulated environment, I think it's much more USDC than anything else. Potentially in some future a euro stablecoin, which is also properly done. Then you have more the trading aspect, and I think in the pre-discussion we had is there's still more pairs probably in the USDT side than USDC side. So on that end, it's probably more that side. So therefore, you really have to differentiate by use case and customer type in that sense. So retail is probably more USDC, and if they studied a bit, they probably like a bit more the audited collateral as well.
fantastic discussion. David, Markus, Kai, thank you very much. And yeah, we'll wrap it up.
Perfect. All right. Thanks, guys.
Thank you.